Welcome to the Deep Dive. We're the place where we take stacks of information, sift through it all, and pull out the key insights you need to get informed fast. Ever feel like success, maybe in investing or business, or really any competitive field is just, well, down to luck? Or maybe some kind of innate talent? Today, we're going to challenge that idea pretty hard. We're diving deep into a concept that's just crucial for anyone trying to navigate complex systems. Could be financial markets, could be strategic planning, maybe even just making better decisions day to day. We're talking about having an edge.
That's exactly right. And, at its core, an edge isn't some mystical thing. Our sources define it as a systematic, repeatable approach, one that gives you a statistical advantage over time. It really boils down to understanding probabilities and then using them to get predictable positive outcomes. Not right away, maybe, but definitely over the long run.
Okay, so our mission for you today is to really get under the hood of what an edge truly is. We want to go beyond just a simple definition. We'll break down the pieces like your win rate, the risk-reward balance you strike, why consistency is so incredibly important, and how data plays a role. And then this is key. We'll show how concepts like the law of large numbers, controlling your emotions, and just pure repetition, how they're essential to actually activate that edge in the real world. Think of it as a shortcut, maybe, to mastering a really fundamental idea.
Exactly. So let's unpack that definition because, it sounds simple, but the practical side, how you approach uncertainty, it has some really profound, sometimes counterintuitive implications.
Okay, let's start right there with the basics. The research we looked at is super clear. An edge is absolutely not just a lucky streak. It's not winning the lottery. It's a method, something you do again and again, that consistently leads to what they call a positive expectancy. It's about tilting the odds even slightly in your favor.
Yeah, and the classic example, the one everyone points to, is the casino. I mean, their whole business, billions of dollars, is built on having a small, systematic edge. Take roulette, an American wheel, right? It's got 38 slots, numbers 1 to 36, plus the 0 and the double 0. If you bet on a single number and win, they pay you 35 to 1. Seems fair.
Exactly right.
But the true odds, because of those 38 slots, are 37 to 1 against you hitting that number. So the payout is less than the true odds. That gap, created by the green 0 and double 0, gives the house an edge, a positive expectancy of 5.26%.
Wow, okay, just 5.26%.
Yeah, this seems small, right? But apply that tiny percentage thousands upon thousands of times every hour across all the tables. That guarantees their long-term profit.
So it's not about the casino winning every single spin. They definitely don't. They lose plenty of spins. It's about that overall mathematical advantage just playing out over countless trials. It sounds so simple when you put the numbers like that. But why is it so hard for, individuals to really internalize that in practice?
Well, I think it's the short-term randomness. That's what messes with our heads. We focus on the single spin or the one trade or the one negotiation. But an edge doesn't promise anything about a single outcome. It only promises a statistical advantage if you do it enough times. It's like flipping a coin that's slightly weighted. You might get 3 tails in a row, sure, but flip it 1,000 times. That bias is going to show up.
And here's something I found really interesting in the sources. An edge isn't actually the same thing as a strategy. They make a clear distinction. The edge is that core statistical advantage, that probabilistic tilt. A strategy, though, that's the bigger plan. It wraps around the edge. It includes things like how you manage risk, how much you bet, your exact rules for getting in and out.
Precisely. That's a critical distinction. The edge is what gives you the potential advantage. The strategy is how you plan to actually use that advantage, manage the risks involved, and execute it consistently. A lot of people, especially starting out, they just chase the magic signal, the perfect setup, and they totally neglected the how. And honestly, that's where most potentially good edges actually fail in the execution.
That difference between edge and strategy is huge. It means just having a good idea isn't nearly enough. You need the whole system around it.
Sure.
And speaking of systems, the sources really dig into the key parts that make up a solid edge. So if an edge is this statistical thing, what are the building blocks? What makes it real?
Right. The research consistently points to 4 critical pieces that have to work together. You've got your win rate, your risk-reward ratio, then unwavering consistency, and finally being meticulously data-driven.
Okay, let's take those first two, win rate and risk-reward, because they're tied together, right? Your win rate, that's just the percentage of times your approach wins. Simple enough. But, like you said, it doesn't exist on its own. It's directly linked to your risk-reward ratio, how much you typically make when you're right compared to how much you typically lose when you're wrong.
Exactly. They have to balance out to create that positive expectancy we talked about. Imagine one example was like this. Say you have a strategy, wins 50% of the time. Dead even, right? If your risk reward is 1-to-1, maybe you make $50 when you win, lose $50 when you lose, well, over time, you're just breaking even before any costs.
Makes sense.
But what if you change that risk reward? Maybe you aim to make $100 when you win, but you cut your losses strictly at $25. Suddenly, even if your win rate drops to, say, 40%, you could still be very profitable. I mean,
Yeah.
4 wins make you $400, 6 losses cost you $150. You're still netting $250.
That's a really powerful point. It shows why chasing just a high win rate can be totally misleading. You absolutely have to know how much you win or lose on average relative to how often it happens.
Mm-hmm. And that brings us neatly to the third piece, consistency. This is huge. It means sticking to your defined plan almost like a robot. No letting fear or greed or even feeling overly confident make you deviate. If you start bending your rules, maybe holding a losing trade too long, hoping it comes back, or chasing a stock that's already run up, you're not actually using your edge anymore. You're just introducing random chance. You basically throw away the advantage you worked so hard to find.
Which leads right into the fourth component, and maybe the bedrock for all of this, being data-driven. This is where you really have to do the work. Rigorous backtesting, maybe forward testing on a small scale. You have to analyze the numbers, keep detailed records, journal everything. Use analytics to constantly refine your system. For traders making decisions in real time, they call them discretionary traders. One source mentioned this DURM method, DURM. Develop your plan, execute it consistently like at least 100 times to get a decent sample. Record every trade meticulously, and then review those records systematically to find and sharpen your actual edge.
Yeah, and for systematic traders, the ones using algorithms and preset rules, it's a bit different, but the principle's the same. It's about studying things that have worked historically, asking why they worked, and then really validating them with your own backtesting. And that backtesting has to be robust. It means accounting for all the real-world frictions commissions, the spread between buying and selling prices, overnight financing costs, or swap.
The hidden costs.
Exactly. Those things can absolutely demolish a theoretical edge that looks great on paper, especially if your edge relies on small, frequent gains. Transaction costs can eat it all up. So it's about knowing the logic behind your edge and then proving it works in the real world with high-quality data. That can take serious effort, sometimes years.
Okay, so let's say you've put in that effort, you've done the research, the testing, you've identified your edge, you built it with these components, win rate, risk reward, consistency, data. How do you actually activate it? What makes it show up in your results? The answer seems to lie in three really interconnected ideas: the law of large numbers, sheer repetition, and maybe the toughest one, emotional control.
Right. The law of large numbers is fundamental here. It basically says that if you repeat something enough times, your actual results will start to look very close to your expected results, the results predicted by your statistical edge. But, and this is a big but, in the short term, anything goes. Losing streaks, they're not just possible, they're guaranteed to happen eventually. Same for winning streaks. The sources even mentioned that crazy roulette example didn't come up something like 32 times in a row once.
32 times.
That's incredible. It really drives home that short-term swings, that variability. It's totally normal. Expected even. So how do you keep faith in your edge when you're in the middle of a nasty drawdown? This is where repetition, just doing it over and over, becomes a non-negotiable, isn't it? Absolutely. That small statistical advantage, your edge, it only gets a chance to work if you give it enough trials. It needs volume. It's like the casino again, thousands of spins an hour. Or a pro poker player playing thousands and thousands of hands. That small edge, multiplied by the sheer number of times it's applied, that's what makes the difference. Without consistent, sustained repetition, your edge just stays theoretical. It gets lost in the noise of random outcomes. It's the steady application, not one amazing play, that builds success.
And this is exactly where emotional control comes in. Some call it having a psychological edge. The sources really hammer this point. Having an edge is just as much about psychology as it is about math, fear, greed, impatience, making impulsive calls, or just freaking out during a losing streak. Any of those can completely sabotage even the most mathematically perfect edge. This is the kind of stuff trading psychologists like Mark Douglas talk about in depth. The mental game is huge.
It really is, because the truth is you have zero control over whether your very next trade or your next decision in any uncertain situation is going to be a winner or a loser. Zero. You have to accept that deep down. Where you do have control is in sticking to your system, managing your risk like you planned, and making decisions based purely on your edges criteria based on probabilities, not how you feel in the moment. Building up that resilience, being able to take the inevitable losses without losing confidence in your process. That's the psychological mastery. That's what lets your edge actually work over time without you constantly messing it up because of emotional reactions.
That makes perfect sense. It shifts the goal from I need to win this one to I need to execute my plan flawlessly over many attempts. So, okay, for you, the listener, what does all this mean for actually finding or developing your own edge? What are the practical steps, whether it's in trading or business or maybe something else entirely?
Well, it definitely takes work and creativity and a really systematic mindset. But the research gives some concrete steps. First, get real experience. If it's trading, that means using real money, even if it's small. Paper trading is useful, but it doesn't replicate the emotional pressure. That pressure is part of the learning. Second, become a super keen observer. Constantly look for patterns, anomalies, things that seem inefficient or predictable, whether it's in market data or human behavior. Where are the consistent opportunities?
Third, yeah, brainstorm like crazy. Write down every idea. Don't censor yourself initially, then test them. Even quick tests, back of the napkin map. Does it even seem plausible? Fourth ties into that. Be incredibly systematic. Keep a detailed journal, not just what you did in the result, but why you did it. What was your thinking? How were you feeling? That journal is your raw data for discovering your edge.
Fifth, read. A lot. Books, papers, reliable websites, but always read critically. Question everything. And crucially, talk to other successful people in your field. Network. It's not just schmoozing, it's about bouncing ideas, challenging each other's assumptions, finding your blind spots. Often, two minds are way better than one at refining an idea into a real edge.
Specialization also seems really important. Becoming a deep expert in one specific niche, maybe one particular market, like options on the S&P 500,
Yeah.
what type of business model, that focus itself can be an edge because you start to understand the nuances, the liquidity, the specific behaviors that generalists just won't see. And maybe your edge comes from something you're already good at, like maybe you have amazing analytical skills from a science background or super fast decision making from years of competitive gaming. It could be about leveraging your unique strengths.
Absolutely. And one final really important point. The world doesn't stand still. Markets change, competitors adapt, information gets priced in faster. No edge lasts forever unchanged. So adaptability is critical. You have to keep tracking your results, maybe retune your parameters periodically, stay curious, stay open to new information. If you just find an edge and then coast, the market or your competitors will eventually leave you behind. An edge is like a living thing. You've got to keep tending to it.
Wow, okay. We have covered a lot of ground today on what it really means to have an edge. We went from the basic definition that systematic, repeatable, statistical advantage through its core parts like win rate and risk reward, and then into how vital things like the law of large numbers, sheer repetition, and that deep emotional control are to actually make it work.
Yeah, it's really clear. It's not some magic formula for winning every time. It's more like a robust framework. A way to approach uncertain situations that, if you stick to it, gives you the best shot at consistent success. Driven by probability over the long haul. Requires discipline, definitely requires data, and a real commitment to always be learning and adapting.
So what does this boil down to for you, listening right now, as you go about your week? We've learned that your edge might not just be about what you do, but maybe it's deeply connected to who you are, the unique skills and perspectives you already bring to the table. So here's a thought to chew on. Where in your life, maybe even outside of work or finance, are you already using your unique strengths, maybe without even realizing it, to get some kind of statistical advantage? And maybe how can you cultivate more of that radical quiet in your own mind? Tune out the noise, the emotion, to really sharpen that focus and let your unique edge shine even brighter.
Thanks for diving deep with us today. We genuinely hope this helps you think about, identify, and really sharpen your own edge, whatever field you're in. We'll talk to you soon.